Okie doke. This week, we're going to begin with chapter 2. So, guys, last week, we talked about how accounting is the language of business. We talked about how every transaction we can fit into the accounting equation somehow. And we talked about when cash goes up or cash goes down, that's an asset. And then something else has to balance the equation. Sometimes it will be we bought land with cash and land went up and cash went down. And then other times we talked about we received revenues and received cash for it, and cash went up and owner's equity went up. So a lot of our focus, and I told you that accounting equation is so important that assets equal liabilities plus stockholders' equity. This week, we're just going to expand on what we learned last week. So every account or every like cash or land or revenues or receivables, each of those categories has what we call an account. This accounting system we're dealing with is designed to show increases and decreases in the accounting equation, and they get recorded in separate accounts. This record, such as cash, land, buildings, accounts payable, they're all called separate accounts. An account has 3 parts: the title, which is the name of the accounting equation element recorded in the account, a space to record increases, and a space to record decreases. So cash is an account. What's another account we talked about last week? Dividends. Remember? When, or drawings when the owner pays himself. Revenues, expenses, those are all different accounts, okay? Here, when we looked at last week and we talked about various transactions, many of the transactions involved cash. That's an account. Some of the transactions involve supplies. Do you remember that? We'd purchase supplies, and then sometimes at the end of the period, we'd use up supplies. And then when we'd use up supplies, we would show a supplies expense and reduce the amount of supplies we used up. Land, that's a separate account. All 3 of those accounts are assets, resources. And then we talked about accounts payable, which is a liability. And then we learned about all of these things that make up owner's equity: revenues, expenses. Each one of those expenses is a separate account. It helps us keep track of what happened. The account form we're going to use a lot in this class. And guys, do you know I still use it? I form what's called a T account. I'll show the title. There's a left side and there's a right side. Some accounts you increase on the left side. Some accounts you decrease on the right side. And depending what account it is, some accounts you increase on the right side and decrease on the left side. And we'll talk about that in a little bit, okay? Now, the amounts that were shown in that cash column back here, you see all these amounts? We started with 25,000, and then we reduced 20, and then we started 7,000, paid something for $36.50, paid for $9.50. Do you see all these up pluses and minuses? This is another way we can show all of those transactions. For cash, increases happen on the left side. So the owner invested $25,000 in the business. So do you see how the left side increased to $25,000? And then we spent $20,000, I think, on land. Didn't our cash decrease there? And then we did something for $3,650. That decreased our cash. $7,500, maybe that was revenues. That increased our cash. Basically, with this account called cash, which is an asset, we call a resource, increases in cash happen on the left-hand side, and decreases in cash happen on the right-hand side. But ultimately, do you see our balance is at $5,900? And if you go back here, do you see it's the same thing? This shows $5,900, but this is just kind of a little easier way of doing it. Does that make sense? Okay. Recording transactions in accounts follow certain rules. Increases in assets. Do you guys remember assets? Part of the accounting equation, assets equal liabilities plus stockholders' equity. It's okay, Denali. I'm just going to write some. I'll call it owner's equity. Assets are on this left side of the equation, right? So when we think of a T account, guys, think of it this way. Since assets are on the left side of the equation, to increase assets, we're going to use this side, which we call the debit side. Does that make sense? Since assets are over here, when we use a T account to increase them, we're going to put it over here because the assets are over here on the left-hand side of the equation. Liabilities and stockholders' equity are over here on the right side, right? So to increase liabilities and owner's equity, we're going to credit it to increase it. Got it? A debit only means left. A credit only means right. What do I mean by that? What's a debit? What's a credit? Right. That's it. For some accounts, a debit is an increase. But for other accounts, a credit is an increase. So what does debit mean? That's it. What's a credit mean? Now, one thing if you talk to anyone else about my classes, I will continue to do this. What's a debit? Right. A debit is credit. Credit. Don't forget that. Because what people get confused of is, oh, a debit means increase. No, a debit means increase for assets, doesn't it? But it doesn't mean an increase for liabilities and owner's equity. Does that make sense? Think of it just like the accounting equation. Remember, we have to balance after every transaction. The same thing's going to be true. Our amount of debits need to be our amount of credits. Does that make sense? Okay. Increases in assets are on the left side of the account. Decreases in assets are recorded on the right side of the account. The excess of debits over credits or credits over debits is what the balance of the account is. Doesn't that make sense? So think of this. Back here, when we saw cash, don't our debits exceed our credits? Here, the 5,900. So do you see the balance as a debit? Right? And guys, we want the balance to be a debit because if the balance is a credit, that means we're in the hole. Does that make sense? If I'm going too fast today, I'd rather you say it again, slow me down, okay? Because this is so important. A group of accounts for a business entity is called a ledger. Why is everyone's ledger different? Well, think of it this way. I have a tax practice. I don't have inventory. So in my Shoemake CPA, we're not going to have inventory in an account. That won't be an account for us. I also am not going to have land and buildings because I don't own anything. I pay rent. Does that make sense? So my chart of accounts, or my ledger, my group of accounts I'm going to use is going to look different from others. So the list of the accounts that I'm talking about right now is called the chart of accounts. My chart of accounts would include cash, equipment, servers and computers and printers and copiers and shredders. I'm going to have rent expense. I'm going to have a service revenue for completing tax returns. I'm not going to have educational revenue or tuition revenue, am I? I'm not going to have buildings and buildings and land because I don't own any of that in my business. So everyone's chart of accounts is going to be unique to their business. So the group of accounts for a business entity we put in a ledger, and the specific accounts a company uses is called their chart of accounts. Know this, the accounts are normally listed in the order in which they appear in the financial statements. So basically, when we look at a balance sheet, and I'll show you that in a minute, we start with assets, then we do liabilities, then we do owner's equity, and then on another income statement are our revenues and our expenses. So that's the order in which they appear. That's how we normally list them. The balance sheet are listed first in the order of assets, then our liabilities, then our owner's equity. Assets, I call them resources. They're the resources of a business to help provide economic benefits for the company. Cash you need for a business to survive. Buildings house the business. Supplies are utilized for the business to operate. Do you understand what I'm trying to get at? Assets are resources. Liabilities are obligations by a business, or I like to call them sacrifices. Liabilities are something you owe to somebody. Okay? Now you owe them because you got a benefit probably, but you owe them. Owner's equity are the owner's rights to the assets of the business after all the liabilities have been paid. The owner's equity is represented in what we call the capital account. The capital account is the money that they invest in the business, and ultimately the revenues minus the expenses flow back through that capital account we talked about. A drawing account is the amount the owner takes out. It's not an expense, guys. It's just the owner taking back some money so he can live. Why is the owner in business? To make money. He's just taking that money he made. Does that make sense? Revenues are increases in assets and owner's equity because we're selling goods and services. Now, the reason it's an increase in an asset and owner's equity, when you come here and pay for school, you either give them cash to pay for school, or you say, my student loans are going to come through. Okay? Think about this from the school perspective. When your student loans haven't come through yet, isn't that like an accounts receivable? It's still an asset because they're going to receive the money. Okay? And then the owner's equity side is the revenue. Your schooling for the school is revenue income. Okay? And then expenses are the cost of making the revenues. Usually with expenses, we have to use cash to buy things. Or in the purpose of supplies, we used up supplies, so our supplies reduce and we show a supplies expense. I'm going to tell you one secret. You'll know it's a revenue because it has the word revenue, generally speaking. You'll know it's an expense because it's going to have the word expense. And guys, apart from one liability, which we'll talk about, maybe next week, maybe this week, I can't remember. You'll know it's a liability because it will have the word payable after it. So guys, in some ways, it's really easy to know what is it, because revenues are going to have the word revenues after it. Expenses are going to have the word expenses. And all payables except one called unearned revenue is going to have the word payable after it. Okay? Got it? Here for Net Solutions is what we call their chart of accounts. These are the accounts that are set up for this particular business. They have cash. They have accounts receivable. They're trying to receive income. They have supplies. Prepaid insurance is when they paid insurance for a whole year. And so it's an asset because they paid it. It's kind of like supplies. They have a whole year's worth of insurance, but they only use 1 month at a time. Okay? Kind of like supplies. They purchased a bunch of supplies, but you only treat it as an expense until you start using it. Okay? Land, office equipment, those are all assets or what we call resources. And they'll all be on the left side of the equation, won't they? Liabilities, there's two of them here. One's called accounts payable, which are just basically amounts we owe to vendors. Unearned rent means, this is unearned revenues, unearned rent. This is the only liability that won't have the word payable after it. Unearned rent or unearned revenues mean that a customer gave you money up front, but you haven't done the work yet. Okay? So the reason it's a liability is you owe them something. You know, in this case, this guy might have paid 12 months worth of rent up front for the year. He gets to live in your place. You know, through the passage of time, you're going to show that as now earned revenues. Do you get what I'm saying? Through the passage of time. Let's say I have a client that gives me $3,000 up front to represent them to the IRS. Until I do that work, won't I owe him that money back? Does that make sense? So technically speaking, until I perform the service, it's not been earned. It hasn't been earned yet. Okay. Then liabilities are on the right side of the equation. And what does right mean? Credit. What does left mean? Debit. But you're right. Assets are on the left side of the equation. Liabilities and owner's equity of the equation. But when we debit something, we put it on the right side. When we credit something, we put it on the left side. Then we have owner's equity, which can be the company, the individual's investments in the company, or the amount the individual may have taken out for drawings. And then ultimately, the income statement flows back into the owner's equity section, doesn't it? The revenues, or you see how this says fees earned. Sorry, it should earn. Usually it will say the word revenue after it. But this one, fees earned is a revenue account. And then all the expenses, so revenues increase our owner's equity and our expenses decrease our owner's equity. Do you guys see every single one of these expenses has the word expense after it? So you'll know it's an expense. Which of the following would be considered an asset in the company's chart of accounts? Yes. Perfect. What is accounts payable? What is travel expense? Expense. And what is revenue? Do you I might be like simplifying it, but I'm trying to simplify it for you so it makes sense to you. Okay? So please hear me. I'm not trying to act like you're little. The best way I learn is for people to simplify it, like to bring it down. Do you ever go to like a doctor's office and they're like talking up here and you're like, dude, I don't know what you're saying. Like, speak on my level. Do you get what I'm saying? I think the sign of a good teacher is to try to explain it to where it makes sense. Who cares who's pontificating up here when you don't even get it? Okay. Got it? Now, we're going to start with an exercise. The following accounts appeared in recent financial statements of Delta Airlines. Identify each account as either a balance sheet account or an income statement account. For each balance sheet account, let's see if it's an asset, a liability, or stockholders' equity. And for an income statement, let's see if it's a revenue or an expense. Guys, I have to run to the restroom real quick because I rushed in here and drank 2 of these things. And if Denali kind of walks away, will y'all just ignore him a minute? Because he might come follow me. Okay, Denali, you stay right here. Mom's going to the bathroom. I'll be right back. Okay? 2 minutes. I'll be right back.
I gotta say, I love this food though. It's hilarious. Yeah, I mean, you have to know that, but like some of it at least, you know, so everything else doesn't know. I don't know. You're not gonna. No, I don't know if they are. I don't know, just like a little knock, you know. Yeah, it's normal. It's like one of those. Wow.
Thanks, guys. Sorry about that. Okay, guys, accounts payable. What would accounts payable be? Is it an asset? First of all, well, let's first say, is it an asset? Is it a liability or stockholders' equity? I'm sorry. Liability. And we know liabilities are on the balance sheet. I don't know why that didn't come up. What about, now you wouldn't, advance payments for equipment. And guys, you wouldn't know this one because that's basically, they put money down on an airplane they have not received yet. So that's a little confusing. That would be an asset. And I shouldn't have a homework problem like that because you wouldn't even know it. What is air traffic liability? Liability. What this is, guys, when you purchase a ticket for December, say you go right now and you purchase a ticket at Delta for December. Do you see why it would be a liability for them? It's like an unearned revenue. You gave them money, but the flight hasn't happened yet. And guys, the flight might not happen. So until Delta earns that money, which means you take the flight, they legally don't claim it as revenue because they didn't earn it. They didn't perform the service for you. Yes.
It's like kind of like if you're talking to a girl or something and your friend is like, so are you talking to anybody? Like I never say I am until I actually go out on a date because you don't really know for sure until you go out on a date.
Kind of like that. Does everyone get that? Yes.
That's kind of like a.
You know what? Hey, you know what? It does make sense to me. Does that make sense? Hey guys, here's the key. What's yours? And so are you telling me you go out on a date, you got it in the bag then?
Not necessarily.
Okay.
Say like
yeah. But guys, do you understand? You do what works for you for it to make sense to you. So thank you for saying that. I thought that was a little humorous. And everyone on the YouTube channel will kind of love that one too. So guys, do you understand that that's a liability because you paid Delta, but they didn't provide you with the service yet. So it's an unearned revenue. What about fuel, aircraft fuel expense? Expense. And what about aircraft maintenance expense? And what about aircraft rent expense? Cargo revenue. Cash. Here, sorry, you can't see that up here. Oh, shoot. What did I just do? Okay, what about, oh my God. Sorry, guys. Contract carrier arrangement expense. Flight equipment. Assets. That's an asset. Frequent flyers. Okay. How many of you guys fly much? You will eventually down the road, but say you fly enough, you get a benefit. So basically, the more you fly, then they start crediting your account for potential future free or reduced flights. So when there's a frequent flyer program, it's a liability because they're going to owe you something. Does that make sense? They owe you reduced fares or free flights. What about fuel inventory? Why? Inventory is an asset. So what this means is it's not fuel that's on a flight leaving. A lot of these airlines have fuel stored. They oftentimes buy fuel months in advance. What about landing fees? Parts and supplies inventory. It's an asset because they're resources that can be used. Okay. What about passenger commissions? Passenger revenue? Okay, this is one I need to tell you about. It says the word expense, but it's not. Any prepaid expenses are assets. What that means is you pay for something up front, but you haven't used it up yet. Just like supplies are a prepaid expense until you use them. Usually they say, apart from supplies, they say the word prepaid on it. Prepaid insurance, prepaid rent. They're all monies you've paid for at least a year or so in either rents or insurance or maintenance, that you haven't used up. So when the word is prepaid expense, it's actually an asset because it's been prepaid, it's been paid up front and you haven't used it. And then taxes payable. Liability. What is on the balance sheet? Assets, liabilities, and owner's equity. The accounting equation is the balance sheet, guys. Okay? And what is on the income statement? Revenues and expenses. Great job. Does that make sense? All businesses use what we call the double entry accounting system. This system is based on the accounting equation, and it means that every transaction is going to have two sides. We were doing the double entry system last week and you didn't even realize it. Do you remember when we were saying paid $300 to buy supplies? And I'd say, what happens to cash? You'd say it goes down. And then I'd say, well, what's supplies? It's an asset and it goes up. Do you see there were two sides to that equation? Cash and supplies. Every transaction we do is going to have at least two accounts. At the end of every transaction, the number of the total of debits has to equal the total of credits. Oh, and guys, what does debit mean? And what does credit mean?
Right.
I know you're going to get sick of me, but that's how you're going to learn it. Okay. You're going to lay in bed and go, oh, those debits are left and credits are right, but you'll learn it. Okay. The double entry accounting system has rules of debits and credits for recording transactions. Guys, put this in your notes. Assets are on the left-hand side. Debits increase assets and credits decrease assets. On this side, liabilities and owner's equity, credits increase assets and debits decrease, credits increase liabilities and owner's equity, and debits decrease liabilities and owner's equity. Can he go somewhere? Okay, this is really good. Does he bother you?
No.
Okay. Okay. So, liabilities and owner's equity, do you see credits increase them and debits decrease them? Okay. The income statement, know that revenues and expenses are ultimately going to flow into owner's equity. So what you think about is revenues increase owner's equity, don't they? So since revenues increase owner's equity, you're going to credit revenues to increase and you'll debit revenues to decrease. Expenses do what to owner's equity? They decrease owner's equity, don't they? How about this, guys? revenues minus expenses equal net income or net profit, okay? Do you remember last week this net income flowed back to owner's equity to be added to owner's equity? So we're used to the net income of of the business flows back to owner's equity. Well, isn't it the same as saying revenues increase owner's equity, expenses decrease from owner's equity? Does that make sense? Okay. I'm trying to break it down so you kind of understand the bigger picture. Okay, so know the rules for revenues. Since revenues increase owner's equity, then revenues increase with the credit and decrease with the debit. But since expenses decrease owner's equity, expenses increase with the debit and decrease with the credit. Guys, until it sinks in your head because you're learning so much, it's not a cheat sheet, but have a side piece that shows you this. So when you're working on a problem, you can go and go, okay, wait a minute. Do you get what I'm saying? Until it clicks with you, have a note. And you, yes, Princess.
I have a question. So every time the government says like the count, do it in some statement count, we would do it this way instead of the way we did it on after when homework was on.
No, it just depends. They're showing you, here's another way to do it. We'll go over the homework and I'll show you, okay? This is another way. When an owner takes money out of the business, what does it do to owner's equity? It decreases it, doesn't it? So since it's decreasing owner's equity, drawings have a normal debit balance. Since owner's equity to increase has a credit balance. So in this case, drawings have a normal debit balance. And to reduce drawings, to reduce it, you would credit it, okay? This is my favorite for this week. Remember this. To know what has a normal debit balance, DEA, dividends or drawings, expenses, and assets have a normal debit balance. LOR, liabilities, owner's equity, and revenues have a normal credit balance. Do you guys see what I'm saying? The word dealer, the first three letters, DEA, dividends, expenses, and assets have a normal debit balance on the left side. LOR, liabilities, owner's equity, and revenues have a normal credit balance. What that means is to increase a dividend, an expense, or an asset, you'll debit it. To increase a liability, an owner's equity, or a revenue, what are you going to do to it? Credit it. And what does credit mean? Right. And what does debit mean? Okay. Rules of debit and credit, normal balances. Until this starts just making sense, guys, have this beside you, okay? And remember, are our quizzes and exams closed book?
No.
No, they're not closed book, okay? This isn't about memory, this is about understanding. Got it? If I had to memorize every tax law, guess what? I'd be retired by now. In the real world, it's just, you have resources to go to, okay? Using the rule of debits and credits, transactions are initially entered in a record we call a journal. The journal serves as a record of when transactions occurred and were recorded. So for example, Chris Clark from last week, chapter 1, deposited $25,000 in a bank account in the name of Net Solutions. The journal entry in the journal we recorded last week, we showed the date it happened. We showed what happened. He deposited $25,000 in a bank. What's one account being affected? Cash. Cash went up. So we always show the debits first, or the things on the left-hand side first. Since cash went up, we show cash debited $25,000. What's another account that was affected? Chris Clark Capital. What happened to Chris Clark Capital? It went up, didn't it? We credit it. Do our debits equal our credits? Yes. So the first thing we always do when a transaction occurs is we journal it. We put it in the journal. We journalize it to say what happened, what accounts were affected, and we always do our debits first, okay? Do you see? Our assets went up, our owner's equity went up, but we still balance, don't we? Right? The transaction is recorded in the journal using the following. We put in the date, the title of the account to be debited, then the amount, the title of the account to be credited, and we also can do a brief description, like in this case, invested cash in business. Make sense? Transaction terminology. These are very common transactions that happen in a company, such as we receive cash for services provided. Well, if we receive cash, what happens to cash? It goes up. And what happens to revenues or services or fees earned? It goes up. Okay? We know cash is an asset. We debit it for it to increase. We know revenues increases our owner's equity, so we credit that to increase it, don't we? Provided services on account. That means we have fees earned or service revenue, but we didn't get the cash yet. But when we plan on getting cash, we're going to use an account called accounts receivable, which is an asset, which means we're getting ready to receive that money. Do you know how we have an accounts payable? That means we owe the money. Accounts receivable is the opposite. We're going to get the money. Does that make sense? Received cash on account. What that means is someone owed us money. So when they owe us money, and we receive the money on account, what happens to cash? It goes up. But they had an accounts receivable with us. They paid their accounts receivable. What happens to accounts receivable when they paid it? Does it make sense? It goes down. So in that example or transaction, cash increases, accounts receivable decreases. They're both assets, but our accounting equation still balances because one asset went up, one asset went down. Does that make sense? Purchased on account. Okay, what this means, because you're learning new lingo. You purchase supplies, but you didn't have the cash. So when you purchase supplies on account, that means you owe them. So purchased on account, whatever that is, we might have supplies. Supplies are an asset that go up. But since we didn't have the cash, we owe them money. So doesn't our accounts payable also go up? Okay. When we paid on account, that means we paid our bill. What happens to cash when we pay our bill? It goes down. What happens to our accounts payable also? It goes down because we don't owe it anymore or we owe less. Okay. Paid cash. What happens to cash when we pay cash? Goes down. And if we had an expense, usually we pay cash because we either owe it, which would be a liability, or we have a cost. So if we pay cash, it might be salaries expense, it might be rent expense, it might be all kinds of different reasons. But the expense increases, or excuse me, the owner's equity decreases. When an owner's equity decreases, that means you debit it. Expenses decrease owner's equity. So expenses are a normal debit, okay? And then when the owner invests in the business, cash comes in, so cash goes up and owner's equity goes up. When the owner withdraws cash, what happens to cash when the owner withdraws cash? And owner's equity goes down. When owner's equity goes down, is that a credit or a debit? When you decrease owner's equity, it's a debit. So you know drawings or dividends are a normal debit balance because it's decreasing owner's equity, right? So this next transaction we talked about last week, Net Solutions paid $20,000 for the purchase of land as a future building site. We can journalize that by saying the date, November 5th. We show the debit first. What happened to cash? It goes down. So we know land did what? Goes up. So land gets debited, cash gets credited. This is a journal entry. When we show the date, we show the first debit, land, 20,000. And do you see the debit is always over to the left? The accounts we use to credit, we indent them and we put that over to the right. And we explain we purchased land for the building. And this is showing you the asset land was debited, the asset cash was credited. Does that make sense? Here's another transaction. This Net Solutions purchased supplies on account for $1,350. The journal entry, we show the date of November 10th. We take our debit first. I always like to say, okay, what happened here? Well, we bought supplies, but we didn't pay for it yet. We owe them money. You know, I just talk it out loud. So what happened to supplies? Supplies increased. Supplies, when they increase, they debit it. So that's the first thing I'm going to put in here. Supplies got debited $1,350. And we're going to credit accounts payable. Because we didn't use cash, we owe them the money. Got it? Yes? Do you see in our accounts, our supplies got debited and our accounts payable was credited? We still balance, don't we? Net Solutions received cash of $7,500 from customers for services provided. Did it say for services where we need to provide in the future? No. If it said that, it would be a liability. Okay? We would increase our cash and increase a liability called unearned revenues. But in this case, we provided the service. So what happens? Cash goes up, and don't our revenues, our fees earned increase? Because revenues being increased increases our owner's equity. That's why we credit it. I always think of revenues and expenses. Does it make owner's equity increase or decrease? If it makes it increase, then we know we credit fees revenues. Because expenses make our owner's equity decrease, we debit expenses. Make sense? How's everyone doing right now? You need to stand up and move around a little? Are y'all okay? Everyone's okay?
I have something to that. Sometime we should do an in-class activity where we like work on something together. I think that would be a lot of fun.
We will do that
Yeah.
next week.
Oh, sweet.
We'll do it next week. Who wants to do that? I think everyone's going to want you. Okay. Here's another one, guys. Net Solutions paid the following expenses. Okay, so guys, what's happening here? In the past, we've just had one and one debit and one credit, haven't we? This is common. All of a sudden, this transaction's a little more involved. Okay? Still easy though. We paid wages of $21.25, rent of $800, utilities of $450, and miscellaneous of $275. Okay? So if we add all those up, it's $3,650. We paid the following expenses. What happened to cash? It went down. And when cash goes down, we credit it, right? So we're going to put that on the right side of the equation. When we have expenses, what happens to owner's equity when we pay expenses? It goes down. When owner's equity goes down, we debit it, right? So do you see all those expenses have a normal debit balance? Does that make sense? So we show wage expense of $21.25, rent expense of $800, utilities expense of $450, miscellaneous expense of $275. Cash is credited for $36.50. Does that make sense? So here we've dealt with 5 accounts, but do we still balance? We still balance. It's crucial we balance at the end of each transaction. Net Solutions paid creditors on account $950. Who can tell me what this means? Anyone? I told you I wouldn't call on you. Yes. Yes, they're paying off somebody they owed. So what happens when you use money to pay off payables? What happens to cash? Cash goes down. Liabilities go down. So for liabilities to go down, what do? We debit them. So do you see here, accounts payable got debited and cash got credited? They both went down, but we journal on, when we create a journal, we always use our debits first. Okay? Net Solutions determined that the cost of supplies on hand at December 30th was $550. Well, that means we used up $800 worth of supplies. So when we use up $800 worth of supplies, we're then going to show it. We're going to show supplies expense increases, which means we debit it, and the asset supplies decreases, which means we credit it. Does that make sense, guys? Is everyone following this? Okay, next. Chris Clark withdrew $2,000 from the business for personal use. What happens to cash when we do that? See, guys, in my mind, I always say, was cash affected? If so, what happens to cash? Because then it helps me understand the other side of the equation. I'm telling you my simplistic way of oftentimes analyzing, okay? Sometimes cash isn't included, but if it is, what happened to cash? Did it go up or down? Okay, it goes down. So we know we're going to credit cash, and Chris Clark drawing gets debited because when owner's equity goes down, a debit makes it go down. That means drawing has a normal debit balance. Okay. I What, well, we'll do this exercise real quick. This is the rule of debits and credits. For each item in A through L, indicate whether the proper answer is a debit or credit. So I'm going to let whoever wants to figure this out. An asset does what when we increase it? What do we do to it? We debit it. And I'll also tell you the normal, when the increase to an account is the normal balance, okay? So the normal balance on cash would be what? A debit. A liability. To increase it, we credit it. So what do we do to decrease it? Debit it. But the normal balance is always the increase. Does that make sense? Capital. To increase it, we credit it. So what are we going to do to decrease it? And again, we know the normal balance will always be the increase. So what's the normal increase of capital? Credit. Is that making sense to you? Okay. Drawing. We don't have any help. Drawing does what to owner's equity? Decreases it. To decrease owner's equity, what do? Debit. So if we decrease owner's equity by debiting it, and drawing will always decrease owner's equity, we know that drawing will have a normal debit balance, right? So to increase drawing is going to be a debit, right? To decrease drawing is a credit, and the normal balance will always be the increase. Revenue increases owner's equity. Therefore, revenue has a normal credit balance. To decrease it would be a perfect. And expenses, what would be an increase? A debit. Does that make sense? Okay. I'm going to move on just so we can keep going. Normal balances of accounts. You can go back and look through this slide. Now, Birdie Consulting Services has the following accounts in its ledger. So what they're telling us is in each of these transactions, we can use cash, accounts receivable, supplies, office equipment, accounts payable, BJ Faust Capital, BJ Faust Drawing, fees earned, rent expense, advertising expense, utilities expense, and miscellaneous expense. Basically, they're telling us we have to use those, okay? So when we paid rent for the month of $3,000, in this case, we're just paying rent for this month. We're using it up. Do you see we would debit our rent expense and credit cash? Does that make sense? Again, in my head, I go, what happens to cash? If cash goes down, I know cash needs to be credited, therefore the expense has to be debited. And we know that's true because expense has a normal debit balance. Who wants to take paid advertising expense? $2,500. What happens to cash? Goes down. So we're going to credit cash and we're going to debit the advertising expense. Okay, guys, paid cash for supplies. What do? Cash goes down, supplies go up. Here's the one thing I don't want you to screw up on your homework. In this class, when we purchase supplies, it's an asset. In the real world, it might be a little different, but in this class, in other words, when I go and purchase $300 worth of supplies in my office, I'm not going to mess with figuring out how much I have. I mean, I'm going to use it up soon. But for this purpose, this is how we're going to do it, okay? In this case, when we purchase supplies, we're gonna debit the asset, okay? We're not gonna debit supplies expense like I do. Here, we purchased office equipment on account. So if it says on account, did we use cash? No. So equipment is an asset that goes up, and our liability accounts payable also goes up. But accounts payable, to increase, it's a credit, isn't it? Does that make sense? Now, guys, receive cash from a customer on account, 14,770. Again, what do I always say? What happens to cash? It goes up. So what are we going to do? Debit cash. And then accounts receivable. Why are we crediting accounts receivable? Why is it decreasing? They don't owe us that anymore, do they? Does that make sense? Okay. Here we paid a creditor on account. What happened to cash? Went down. And what happens to our accounts payable? It goes down. Why does it go down? We don't owe them it anymore, do we? Okay. Paid cash for miscellaneous expenses. We debit our expense, we credit our cash. We paid the utility bill for the month. We debit our expense, credit our cash. What about this? Fees earned and billed to customers for the month. Guys, tell me what that means. We billed to customers for the month. Did it say fees earned and we received cash of $37,300? No. So what does this mean? They're going to pay us in the near future. They haven't paid us, but we did the service, so we record the revenue. So we debit accounts receivable because that means we're going to receive that money in the very near future. Got it? Here's we paid a utility bill, and then here we gave B.J. Faust a drawing. The drawing account increased and cash decreased. Does it make sense to you when we look at each transaction and we pick it apart? To put it in this journal form, we have to take the debit first. And what I do is I just try to go, okay, what happened here, guys? First of all, what accounts were used? And then once I decide what accounts are used, then I decide what happened to them. Did they increase or decrease? And then if you use your, sheet, you can say, oh, when this increases, I credit it. Or when this increases, I debit it. Or if it's a decrease, you credit or debit. Does that make sense? Slow it down and just take one at a time, and it will make sense. Sometimes for me, when I look at the whole big picture, it's overwhelming. But if I just take one transaction, okay? Am I making sense what I'm trying to say to you? If you just take one transaction, it's like, that wasn't hard. Okay. This is kind of a helpful exercise. What we're going to do, this is Crazy Mountain Tours, a travel agency owned by Ted. There are 9 transactions that were recorded by Crazy Mountain in its first month of operations. Indicate for each debit and credit whether an asset, liability, owner's equity, drawing, revenue, or expense account was affected and whether the account was increased or decreased. So what we're going to do here, in number 1, do you see the number 1 shows a debit of cash of $50,000? And do you see a credit to Hager or Ted Jaeger for $50,000? Do you see in this case cash was debited 50. Owner's equity was credited 50. So what happened to cash? It went up. What happened to owner's equity? It went up, right? What do you think happened here? Ted invested money in the business, right? Okay, excellent. Next one. Number 2. Do you see number 2 shows a cash on the credit side of 4,000 and supplies of 4,000? Do you see supplies is debited and cash is credited? What do you think happened? Purchase supplies for cash. Is this making sense? Sorry, I say that too much. 3, cash went down 10,000 and come on. Accounts payable went down. Did I screw this one up? Oh, thank you. So in this one, there's 3 accounts that are being affected. Do you see cash went down 10,000? A liability went up 20,000 and an asset called equipment went up to 30,000. What do you think happened here? Lena, right? Perfect. Exactly. They purchased a piece of equipment for 30,000. They paid cash of 10 and they owe 20. Excellent, guys. Do you see how you're already learning how this is working? Next, number 4. You see cash went down $6,175 and operating expenses went up or were increased, debited $6,175. So they probably paid for some expenses, right? Next, number 5. Accounts receivable of 20,500 and service revenue at 20,500. What happened here, guys? They earned some revenues, but they haven't received the cash yet. So that's why it's an accounts receivable. Okay. Then here, 6, cash went down 6,000 and accounts payable was debited or also went down 6,000. What happened here? They paid off an accounts payable. Excellent. Do you see, this is why I like accounting. It really does make sense. Number 7. Guys, look at number 7. Accounts receivable got credited and cash was debited. What happened here, guys? We got paid people who owed us. Okay. One thing people confuse is who owes us and who do we owe. When we owe someone, it's a payable. When someone owes us, it's a receivable. Okay, no, people get that confused. We're going to receive money. Okay, we are receiving it. It's due to us. When we owe, it's a payable. Okay, next. Operating expenses were debited 2,200 and supplies were credited 2,200. What happened here? We used up supplies. So we reduced the supplies by crediting it And we showed supplies expense or operating expenses as a debit. Okay? Drawing. In number 9, cash went down 1,500 and Ted Jaeger drawing went up 1,500. He took some money out. Guys, it's wise in business to make a living. Okay? So we basically just did this in 13. What we did is we looked at these and we created journal entries basically, right? So I'm going to kind of move on just so I have enough time. One thing I want to encourage you with for this week is when you have questions, there's a discussion board for chapter 2. Ask questions. A lot of you are emailing me and Stuart, which is totally acceptable. And I want you to continue doing that, but also put them in the discussion board. Because if you have that question, it really helps to engage each other to go, yeah, I was wondering that too. You get what I'm saying? So feel free to email me or you can text me and say, hey, I just put something in the discussion board. Will you answer it? Remember how I told you can do that? But you're not going to call me, right? You get what I'm trying to tell you. But you're not going to always remember all this stuff. So ask questions. Use that throughout the week to work together. Remember, are you allowed to work on homework together? Yes. Don't sit and fret. One of the other classes, one guy spent 20 hours on this homework. Crazy. He should be working with other people, getting on there saying, hey, let's work together on this. The purpose of homework isn't to suck your time dry, it's to help you learn. Okay? Next. Now, once we do these journal entries, we then post them to the various accounts. The process of transferring the debits and credits from the journal entries to the accounts we call posting. Often, like right now, we're using T accounts to show where they go. But oftentimes we use what we call a 4-column account that helps us show them to the account. So in this example, Net Solutions paid a premium of $2,400 for an insurance policy for liability, theft, and fire, and it covers a 1-year cycle. The reason we don't take this and put it right away into insurance expense is because it's a prepaid insurance policy that's going to last us a full year. So we're only going to expense it as we use it up. Okay? So in this case, we're going to debit our asset called prepaid insurance for $2,400 and we credit cash for $2,400. To post it means we're going to take that account called prepaid insurance and we're going to go and show the date and show a debit of $2,400 there. Then we're going to go find the account cash. We're going to go, it's funny how he wants to be up. See you guys. He wants to, we want to then go find the account cash and credit it. So we show, do you see here on cash, December 1st, credit $2,400. That's posting it to the accounts. It's just what it means. We take those numbers and post them to the specific accounts. The debits and credits for each journal entry are posted to the account in the order in which they occur in the journal. The debit portion of a journal entry is posted to the prepaid account by using the date, putting the amount in the debit column, and then we go and find the journal page number 2 is entered in the posting reference. Okay, do you see here, prepaid insurance, that account is account 15. So accounts are often numbered, okay? So you see prepaid insurance is number 15, we show that. The cash account is number 11. and we show the dates and we just post them to the various accounts. Know that when we create a journal entry to post them, we take this prepaid insurance here, account prepaid insurance, and we debit it. We took this cash over here and we showed a credit in the account for cash. Cash is going to usually have a ton of transactions to it because that's primarily the account we're using. When Net Solutions pays rent for December of $800, the company from which Net Solutions is running its office now requires the payment of rent on the first of each month rather than at the end of each month. In this case, we're going to do on December 1st, rent expense for $800 and we credit cash for $800. Do you see when we post it, we go over and find the account rent expense and we show a debit in there. And then we find our cash account and we put a credit in there. It's that simple. We're just transferring. Okay? Now, thank God in this day and age, we have software to do this for us. One of my first jobs I had after I got out of college was working at a mortgage company. And this was back in '82. And guys, all this was done by hand. My general ledger was like this big, and I literally had to go to the various accounts in this book. I know, what a waste, huh? But it just was the way it was back then. Most mistakes aren't going to be happen by thinking it through. It's by error of a debit versus a credit, okay? Net Solutions received an offer from a local retailer to rent the land purchased on November 5th. The retailer plans to use the land as a parking lot for its employees and customers. Net Solutions agreed to rent the land to the retailer for 3 months with the rent payable in advance. Net Solutions received $360 in advance. Okay, the first thing I'm going to think is this transaction, someone gave us money for $360 for 3 months of rent. Okay, what's the first thing I'm going to ask you? What happened to cash? It went up. So cash increased 360. Then we have to think what other account was affected. The first thing you're going to want to go is rent revenue, but it's not because they're giving us 3 months right now. Have we earned it yet? No. That's why we call it unearned rent. Okay? It's a liability until we earn it. So do you see? We debit our cash of $360. We credit our unearned rent of $360, which is a liability because we owe them something. We owe them renting the land. And then we explain, received advance payment for 3 months of rent. We take our cash and we show a debit there for December the 1st. And then our unearned rent, which is a liability, we credit. Make sense? We purchased office equipment on account for $1,800. Okay, guys, what happened to cash? Nothing. It's on account, right? It didn't say we purchased office equipment for cash. It said on account. So, and I'm telling you these things to just make you go, oh yeah, we owe them. So office equipment is debited because it's an asset. Accounts payable is a liability that got credited. You see that? So when we post, do you see we take our asset office equipment and we debit it? And then our liability accounts payable, we credit it. Make sense? Oh, I already have that one. I don't know why these got doubled. So, that's weird. Sorry, guys, I have a bunch in here backwards. I apologize. Wow. I apologize. That's crazy. Um, oh, I'm going. All right. This isn't the normal computer I use. Okay. So I'm kind of skipping forward a little here because I need to get moving on. So all of these various transactions we record or journalize, we post them to each of those accounts. And then guys, at the end of, once we've done all this, we've got a ledger showing all the debits and all the credits we've made. And we show to each account what we've debited and credited. We've posted all these accounts. When the transaction with land, we've posted that. We've got various transactions that all have debits and credits posted to them at the end of the month. Which of the following is the process of transferring debits and credits from journal entries into accounts in a ledger? Posting, okay? So on February of 2029, Quick Fix Company purchased $2,250 of supplies on account. In Quick Fix's chart of accounts, the supplies account is number 15 and the accounts payable is number 21. Journalize the February 11th, 2029 transaction on page 73 of Quick Fix Company's 2-column journal. Include an explanation for the entry. So do you see here, we're showing on February 11th, our journal entry is supplies for $2,250, and we credit accounts payable for $2,250. Okay, then we explain we purchased supplies on account. Then what we do is we post this debit to supplies of $2,250. Do you see how we posted here February 11th, $2,250? Does that make sense? This is page 73. We show in this account, page 73, to post our $2,250. The accounts payable of $2,250, we show February 11th. The page is 73, we credit $2,250. In the real world, the software does this today, thank God. But you need to understand how it works, okay? No, do the rules of debits and credits apply to all companies? Absolutely. Every transaction, our debits need to equal our credits, okay? So these various exercises allow you to continue to get understanding on how you journal entries and how you post them. Once we are done creating our journal entries and posting them, all accounts then have an ending balance. We are going to create a trial balance, which is just a list of every account and the balance of debits and the balance of credits. Errors can occur in posting debits and credits just because you get it wrong. In software, it's not going to happen, but in human terms, it will. So this trial balance we call it an unadjusted trial balance right now, only is a list of every account in your chart of accounts that has a balance. And if it's an asset, they're going to have a normal debit balance. We'll post those balances. If it's a liability, won't it be a normal credit balance? And then Chris Clark Capital's a normal credit balance. Drawing is a debit balance. So we start with the balance sheet and list all those in the order of the balance sheet. Then we go to the income statement. We show our fees earned and all of our expenses. All this is doing is making sure our debits equal our credits. And they're going to, aren't they? Because after every transaction, our debits had to equal our credits, didn't they? Got it? If the trial balance totals aren't equal, guess what? Something happened. The error must be found and corrected if necessary. You got to figure out why your debits aren't equaling your credits. It's so easy when you're doing it by hand for it to happen. An error can occur that doesn't affect the trial balance, but generally it's because you input the transaction incorrectly. Meaning, purchase supplies on account. What if I say supplies 2,000, cash 2,000? I screwed up that particular transaction, but it's not going to change. It's not going to show up on the trial balance because it's going to balance. It's just that I didn't say accounts payable. I took cash. Am I making sense? So basically, events can happen that can affect, you can mess up. And so sometimes we have to correct those transactions that we did wrong. So in this case, they showed supplies, a transaction showed supplies was debited instead of office equipment. So to fix that, do you see what they're doing? They're debiting the office equipment and crediting supplies to put it to the right place. That's going to happen at times. No, the trial balance is going to just give you a list of your debits and credits. Now you'll be able to know your net income from the trial balance before any adjustments, because do you see here, you can see your service revenue and your expenses. And we know our net income is revenues minus expenses, don't we? So you'll be able to see that from a trial balance. I am so sorry. I sometimes put in too many exercises in these PowerPoints. But at least you can go through here, and if you want some more learning, you can see some extra information here. This primarily, when we talk about horizontal analysis, I'm going to let you look at that later. And we're also covering horizontal analysis in the last chapter of the whole book. So guys, know that I will post in a lecture for the content section week 2, some help so you can go through some problems and follow me, okay? Any questions before we leave? How's everyone doing?